All right, stepping in for Nastasia Aronsa today. Let's take a look at your markets. Asian markets ended the week on a mixed note. Market players are still digesting the Fed's decision to move quickly to tighten monetary policy on higher inflation concerns, which has created some level of nervousness. In Japan, the Nikkei share average ended the day basically flat or down 0.03% to close at 28,479 index points. Hong Kong markets were subdued, with the Hang Seng index declining by 0.2%, closing at 3,580 index points. While in mainland China, sentiment looked better there, with the Shanghai Composite Index rising by 1.82% to close at 23,493 index points. Over in the United States, the S&P 500 ended a volatile session close to unchanged on Thursday, with financials among sectors lending support a day after the market sold off on a hawkish slant in the Federal Reserve's minutes. The S&P 500 lost 0.09%, the Nasdaq Composite lost 0.12%, while the Dow Jones Industrial Average fell by 0.47%. All right, let's take a look at how other markets are performing. All right, well, I'm joined by Gary Boyson. He's a portfolio manager at Rand Swiss, just to break down the markets for us. Thanks very much, Gary, for joining us. Now, I suppose the most significant thing that markets are still having to grapple with is the fact that the US Fed is planning to accelerate its monetary policy plans, and it also looks like the ECB is likely to follow suit.
Yeah, I think as we move into 2022, the whole idea that we're going to face a tighter monetary policy across the globe is certainly weighing on stock markets, and it's the forefront of traders' minds. So as you mentioned at the head of the show, the FOMC on Wednesday, those minutes showing that the Fed is a little bit more hawkish than we previously thought. I think the idea that we have transitory inflation has started to be suppressed, and the idea that we might have a little bit more persistent inflation is coming through. Obviously, this is absolutely key with how you position in any financial markets, because this essentially gives you your cost of current capital. At least it's your risk-free rate. So it's absolutely crucial to see how they move.
When you look at Bitcoin, it does seem like it's still in the realm of casino. I mean, it's just plunging. It shoots up and then it plunges. People have made lots of money, and I guess people are losing lots of money as well. What's your assessment of this particular asset, if you can call it that?
No, certainly you see it on more and more financial news sites. So it seems to be establishing itself as a yes, an alternative asset class, but there's no question it is an asset. It is an asset class. Whether it's a currency, that's a much wider debate. But Bitcoin under a lot of pressure today, down around $42,000. I think one of the interesting things around crypto at the moment is just the size that the crypto markets have managed to gain in 2021. And the question is, are we going to see the same thing from 2022? Obviously, Bitcoin, and Ethereum, the two largest by market cap, showing that there's a huge demand for this decentralized, currency that doesn't require regulation and borders, etc. But whether we're going to see it still being prevalent towards the end of the year, almost impossible to tell.
So, what do you view as some of the main themes that are going to influence markets in 2022?
I think the big theme is going to be the speed at which inflation is brought under control. I think that's looking at the consensus estimates, most people believe that the price of goods and services, these spikes that we've seen, are going to be tamed. Part of it is because of obviously the disruptions that we saw to COVID, the big supply chain issues that we saw last year, and a couple of other factors. And they think that potentially higher interest rates and a return to normal will see inflation moderate. If this isn't the case and we see persistently high inflation, it's going to change the way that you almost need to invest in financial markets. So from a stock point of view, the cost of borrowing for companies goes up. It becomes more, and because that becomes more expensive, essentially there's less profit for shareholders, and you should see the share prices coming down. At the same time, the reason that you raise interest rates is to tame inflation, and companies that do well in higher inflation environments that can push on those price increases to consumers tend to do very, very well, because you can't can't sit with cash in the bank either. So I think the idea on inflation is going to be an absolute key theme. I think the digital migration that we've seen over COVID is also going to be pretty important. The whole idea of the metaverse that has become a little bit of a buzzword. And I think the other key trend that we're looking at is the idea of reverse globalization as well. The idea that we are going to see probably the continuation of higher tariff barriers, maybe people moving the hubs of production out of the emerging markets in places like China and setting up more highly automated factories closer to the developed market consumers, which I don't know if that's going to be good news for South Africa, but it's certainly a trend we've seen starting to emerge, and I think we'll see it playing out through 2022.
And then lastly, Gary, I mean, with interest rates almost certainly likely to go up globally, how does that then inform equity investors' conduct? Because obviously, suddenly equities become less attractive and it becomes more attractive to invest in currency, for example, like the US dollar and other commodities that are related to it. Your thoughts?
Yeah, so like I said, when you see interest rates going up, absolutely. If you look at US dollars, euros, pounds, those hard currencies, they essentially offer investors no interest rate at all at the moment. Those money market accounts, for South Africans looking at them, we're very disappointed. We're used to a slightly higher interest rate regime. But as interest rate rise, as you say, that becomes a viable alternative to having to be forced into equities. Now, the problem is as interest rates are rising, the move into rising interest rates generally tends to devalue currency as well, because the reason, as I said before, the reason that the inflation, at least the reason that interest rates are going up, is because there's inflation in the system. So if you're just sitting and holding either dollar or pound or euro balances, you're just holding onto your cash and you're hoping that that's going to be enough to protect you from inflation as the price of everything around you gets more expensive, you might be disappointed. And for that reason, stocks do still serve as an inflation hedge, but it really depends on the type of stocks that you invest in. You really want to look at companies that have low gearing, so not a lot of debt in the balance sheet, because obviously as interest rates go up, their debt will become more expensive. You're also looking traditionally at more value stocks rather than growth stocks. So growth stocks are the type of companies and the type of stocks that promise you, big future earnings in future. They typically are the technology-based stocks. They might not have product now, but they've got a great idea that will one day be developed. Those stocks tend to do very poorly under a rising interest rate environment. On the other hand, the value stocks, the more established companies that produce things every day, things like motor cars, they generally trade on lower PE, but they deliver cash and higher dividends to shareholders. Those have been out of favor for a long time, and I think we might see a little bit of a recovery if we see persistently high inflation and obviously the subsequent increase in interest rates.
Gary, thank you very much for your insights there and that really cool backdrop at the JSE. That was Gary Boyson. He's a portfolio manager at Rand Swiss. We'll have more news for you after a short break.